Thanks for joining us here on Market Call. I'm Morella Fernandez. Today, Stan Wong is on the show. He's portfolio manager at Scotia Wealth Management, and he'll take your questions on North American large caps and ETFs. Here's how to reach us today. Give us a call at 1-855-326-6266. You can also email your questions into Market Call at bnnbloomberg.com. Again, Stan Wong in-house to give you his feedback on your stock questions. Let's have a discussion before we get there. A lot of fluctuations, obviously, Stan, with the trade war. I'm wondering what kind of advice you're giving to investors today when they are worried, concerned, and maybe acting impulsively.
First off, thanks for having me on the show. I think we got to look back at history. When you look at 2018, the trade war between the U.S. and China, the S&P 500 did drop nearly 20% in Q4 of 2018, but it rebounded with a 31.5% return in 2019. So we take some of those cues from history. And then the other thing that I looked at, when you looked at the last 6 sort of 10% corrections or more, which we're facing right now with the S&P 500, going back to 2009, the one-year return in the S&P 500 was 40%. So again, that's history. Doesn't necessarily mean that it'll happen again, but history often rhymes. It's not going to repeat, but it will rhyme. So I think we got to look back at the fundamentals, and the fundamentals are still solid. When you look at the U.S., GDP is fairly solid. If you look at the last quarter, inflation, as you know, ticked down, and the consumer remains pretty solid, and unemployment is hovering near multi-decade lows at 4.1%. You know, the lowest 3.5% over the last 50 years.
So let's counter that for a moment with the president recently saying, as you know, on the weekend, yeah, we may be in for a temporary pause, which is what he likes to say instead of the word recession. Do you expect much of that then to change given that signal and given everything else going on?
I just have to wonder how much of that is posturing, how much of that is negotiation and so forth. So I think it's really premature at this point to say we're looking at a recession down the road, because even when you look at 2018, 2019, inflation was around 1.92%. So even with those tariffs that were coming into place on a much bigger economy, you know, China is 20% of the world GDP. Again, very premature to think about recession and flipping the economy from a soft landing into a recessionary area.
Okay, so short term, would you make any moves, or what are you asking investors to look at short term? And what I mean is like the next 3 to 6 months.
Look, choppiness, I think, will continue as long as this rhetoric is there. With that being said, I also should mention that we need to consider some of the political considerations coming up. The midterm elections are approaching next year. So would the administration in the U.S. sort of stem some of its talk? Will they start to put policies in place that will help the economy, whether or not that's more deregulation or more tax cuts? So those are things that will help the stock market, help the economy as well. I think that this is an opportunity for investors to take advantage of some of those names that are down 20% or 15% or even more.
Okay, and would you dip in, or would you sort of go in a bigger way?
We are using cash and adding to names that we like, high quality names that we think are great names over the next 3 to 5 years.
Okay, we're going to be back with Stan Wong. He's portfolio manager at Scotia Wealth Management, taking your questions on North American large caps and ETFs. We're back in a moment. Stan Wong in-house today to take your questions. We'll go right to the phone lines. David's on the line calling from Ottawa today. Hi, David.
Yes, good afternoon. Thank you for taking my call. My question is on CNQ and Canadian Natural Resources. For the past year or so, it's been going one way, and that is down. I think it's off about well over 10% from its high, if not more. Question, why is that the case? Is it due to oil prices or political instability? Do you own CNQ for yourself and for your clients? And if you don't own CNQ, what other stocks do you like in this sector? Thank you very much. Have a great day.
Might be both that's fueling that drop, right? Oil price is part of that?
Yeah, I think so. I mean, concerns about the economy, just the sentiment around energy stocks is a little bit lower at this point. As you know, it was all about technology and communications. And more recently, up until the last few weeks, financials have kind of taken the lead as well. So, oil stocks and energy stocks have really fallen out of sentiment to some extent, oil prices being a little bit weak as well. Long term, I think it makes sense to own oil or energy names. I think there's a lot of value in some of those names at this point. With CNQ, we do not own this name. We exited this name some time ago. When I look at the charts, the 200-day moving average is really kind of flat and trending slightly downwards now, which is not positive. And the price is now below the 200-day moving average at this point. And the stock is down about 26, 27% from recent highs in terms of a drawdown. So, some of the technical structures don't look great. If the stock starts to base and we start to see some recovery and the 200-day starts turning up and we get above that 200-day, it might lead us to buying the shares. I see that the yield's around 5.65%, which is good, but all the other things like technical structure and so forth leads me to be away from this stock. I think the other question was what energy names we own in the portfolio. It's Suncor we own in the portfolio right now, is the only remaining true energy name in the portfolio.
Are you surprised that you're seeing a trend toward lower oil prices, considering Donald Trump is very pro-oil and wants to see more of it come out of the ground?
Well, I think it's countered by the fact of the concerns about, hey, are we going to see a slowdown in the economy because of these tariffs, because of all the things that are happening, the retaliatory tariffs and so forth. So I think that's, use a better word, trumping the idea of Donald Trump President Trump wanting to increase oil production. I think just the concerns about slowdown global economy is beating that at this point.
Got it. Okay, let's go back to the phone lines. Michael is on the line from Vancouver today. Hi, Michael.
Hello, Marilla. Hello, Stan. Stan, thanks so much for taking my call. Stan, my question is today. I know in the past your favorite low MER, low beta, high dividend ETF in Canada has been XEI. And I'm just wondering if you have a similar type of ETF that you use for U.S. equities. And at this time, Stan, would you just wait for our dollar to gain some momentum against the U.S. before buying any U.S. equities or ETFs, as we're paying a pretty hefty price for any U.S. stocks and ETFs? Thanks so much, guys. I'll hang up and let's do a response.
Yeah, the Canadian dollar still hovering in under 70.
Yeah. So to answer the question about the U.S. ETF, one of the ones I like is the Vanguard Dividend ETF, VIG. It's a dividend appreciation ETF. I tend to like some of the ETFs that are able to select names that have rising dividends over time. So this one, you're paying 5 basis points in terms of an MER, so very reasonable. Okay. Some of the top names in there would be Broadcom, Apple, JP Morgan, Microsoft, Visa. So usually typically high quality names. The performance of this ETF has been very strong, up about 16% over the last 5 years on an annualized basis, down about 1.87% year to date. Okay. So not too bad given all the things that are happening out there. With regards to currency, I think the one thing that I would say about currency is with the interest rate differential between Canada and the U.S., I have to wonder when we see this big rebound in the Canadian dollar. It might be some time before we see that. And also along those lines, I think it's important to diversify. We talk about diversifying asset classes, diversifying sectors. You want to diversify your currencies as well. So maybe not have everything in Canadian dollars if you do today. It's important to have U.S. dollars as well. And obviously that's worked out very well for investors over the past few years.
Got it. Okay, let's go back to the phone lines. And Elliot is the next caller from Hamilton, Ontario. Hi, Elliot.
Good afternoon. Please, still down or coming down from recent highs, how would you assess the prospects for Live Nation, and at what price, if any, would you start a position LYV? Thank you.
Live Nation's building out quite a bit, aren't they?
Well, yes. I mean, they virtually have almost monopoly on not just the ticket space, but also on the concerts and so forth. Right now, the shares are down about 27% from recent highs just last month. That seems to me to be a bit of an opportunity. Sure, we might see more choppiness ahead, but it's down 27% from just a few weeks ago. It's also right at the 200-day moving average right now, which could be a support level for the shares. So I think there's a nice opportunity for a very high growth type of company with really not a lot of competition or very little competition. We're seeing about 12 to 15% earnings growth from this company. It's a bit pricey at 35 times forward earnings, but you're going to pay up a little bit for a name that has very little competition. Is
it clear what's been hitting it over this past few weeks, or do you think it's just generally the market and what's been going on with the U.S.?
Yeah, I think it's part of the broad-based sort of decline. A lot of growth stocks have been falling off a little bit. I think also concerns about the consumer. If there's all these tariffs that are happening, how much money is left in your pocket to go to a concert or see Taylor Swift or go to the Leaf game and so forth?
Yeah, all of that money's been blown a while ago. So yes. People are holding still, You're right, to see what happens if there is a downturn. Okay, let's go back to the phone lines because Rob is on the line. He's calling from Calgary today. Hi, Rob. How can we help you?
Hi. Thanks for taking my call. I'd like to hear Stan's opinion on Emera, or if he'd prefer an alternative option in the utility space. I'm looking for both a total return from growth and dividend payouts. Thanks again, and have a good afternoon.
Thank you.
So not a name that we own in our portfolio as a utility company. It's been great to hold a utility company over the last month or so with all this volatility, as it would have been for things like consumer staples or healthcare. Those are the mainstay defensive areas that you want to be in when things get a little bit volatile. From a growth perspective, you're probably not going to see a lot of growth from utility companies such as Emera. I see about a 7% growth rate on Bloomberg here going forward. So, typically not the names that I own as a money manager. I tend to look for a bit more growth in our companies that we want to own. But again, great place to be when you want to get defensive and you want to sort of shelter from all the volatility. And on top of that, you're getting a 4.9% dividend yield.
Okay. We are going to take a quick break. Stan Wong is sticking around, portfolio manager, Scotia Wealth Management, taking your questions today on North American large caps and ETFs. Back on.
The next question.
Thanks for joining us back on Market Call. Stan Wong's in the chair today. We're going back to your questions. We have Bernie on the line. He's calling us today from Toronto. Hi, Bernie. What's your question today?
Good afternoon. My question is on Capital Power. It's had a huge pullback, but it's paying a nice dividend. But on the other hand, would you hold it, sell it, or add to it? Thank you. I'll listen to your answer.
Thank you.
Thanks for the question. So as I mentioned with Emera, like utilities isn't really your growth type of area, which I tend to like a bit more. With this stock, it's come down to just below the 200-day moving average. So that's something you want to watch out for at this point. Obviously, it's should be a more defensive area given what's happening around the world. You're getting a 5.5% dividend. But again, for me, longer term, not really a growth type of company. So it doesn't really end up in my portfolio. If you're looking for steady yield and so forth, that's something else. And when you look at the growth for this company, there's actually, I don't even see a growth number. So, I think there's some variance with what analysts are saying. But beyond, say, 2025, we're looking at only 6 or 5% earnings growth. But again, for an income investor that's looking for yield, this may make sense.
All right. So it depends on sort of where your situation is at currently.
For sure.
Let's go back to get a question from an email. This is Mitchell who emailed in. He says, I would like the guest's thoughts on UnitedHealth, which is the United Healthcare Group. I got my position approximately about a month ago, and the death of the CEO, and now they are experiencing some other regulatory problems. So the question is, it is approximately 2% of my portfolio, down 13%. Worthwhile to hold or sell?
Yeah, thanks for that question. So we do own UNH in our portfolio. It's obviously the leadership in that space, trading at 16 times forward earnings with an 11% earnings growth rate forecasted, which is a pretty reasonable expectation. When you look at the last 5 years, the earnings have grown by 12% a year. So, what's going to happen forward is kind of what's going to happen, what has happened in the last 5 years. The 200-day moving average has been trending higher. The price is a little bit below that. So it's a bit of a neutral technical mix there. But you've got that integrated model of insurance, pharmacy benefits, and healthcare services. So, being able to bring that together for consumers is very strong. Membership growth is still growing and pricing power is on their side. So you've got revenue expansion. So Those are positives. It is down 24% from recent highs based on these regulatory concerns. I think it's a little bit overdone. I think the price is a little bit lower than where it should be, and we continue to hold it.
Got it. Okay, let's go back to the phone lines. John's on the line from London, Ontario. Hi, John.
Hi, Marilla. Good timing, Stan. I'm going to pick your economic brain here. You mentioned about the pullback in Trump 1.0 and then the rebound of 35% the next year. The next pullback was 2020, and the resource stocks were the leading sector to bring us out of that slump. The next slump is now. Which sectors, the stock market is a leading indicator because it looks 6 to 9 months out and tries to predict future earnings. Which sectors do you think will be among the leaders leading us out of this slump? Thanks very much, Stan.
Yeah, interesting question. Can you take a gauge on that?
I will certainly try. Thank you for that question. So I would suggest that, looking 6 to 12 months out, assuming that we don't, fall into a recession, which I still think is very premature to even start seriously considering that. I would say your financial sector is a great place to be, just given the fact that the economy has hit a soft landing and inflation is relatively low, unemployment is relatively low, and business activity is increasing. Financials will be a big beneficiary of any greater deregulation coming from the Trump administration as well. And tax cuts, they'll benefit from that, from consumers being able to spend. I would suggest the industrial sector should do well. And I'm kind of focusing on some of the U.S. sectors here. It can tie into the Canadian sectors as well, but more of the focus is U.S. I think industrials would do well because there's more of a focus on domestic manufacturing. So names like Caterpillar, Otis, and so forth should do well. And I think selectively you want to be in the tech and communication sector because just simply some of these names, I mean, the Mag 7, not that it was cheap to begin with a few months ago. Now it's back to 2017 or 2018 levels in terms of valuation. So I think there's something to be said about that.
Meaning you think they'll come back?
I think that the growth rates are still there, 15% or more, or even greater, 30% for Nvidia. I think some of these names are cheaper than it has been in a long time.
Got it. Let's go back to the phones. Nazar's on the line calling from Scarborough, Ontario. Hi, Nazar.
Hi, Marilla. Hi, Stan. Stan, may I have your thoughts on ZWB, BMO covered call Canadian banks? Would you recommend buying covered calls in these uncertain times when the market is so volatile and also banks have retreated? Alternatively, would you say ZEB, BMO, S&P, TSX, equal weight banks would be your preference at this time? Thanks for taking my call.
Thank you.
Thanks for the question. So ZWB, the BMO covered call Canadian banks, is basically a basket of the Canadian banks with a covered call overlay over them. And with that, you'll get a 7.1% fairly tax-efficient yield distribution from dividends and from return of capital. So great for investors that want that yield or need that yield. However, I've always said that when you look at these strategies, more times than not, the underlying securities will perform better on a total return basis. So if I were to track this against the TSX banks or just the ZEB, which is what this is overlaying against, in the past 1 year, the total return for ZWB would have been about 9.5%.
Okay.
And for ZEB, which is just the banks, no covered calls, you'd be nearly 14%. And the same thing will hold for the last 3 years. You would have had a better return holding the banks themselves and no covered calls versus holding the covered call strategy, just because you're getting struck out as prices go higher over time and you're not getting that upside.
Got it. Okay, that's some good advice. We are going to take a quick break here. Stan Wong sticking around. Here's how to reach us. We're going to look at past picks when we come back. Welcome back. Time now for a look at past picks with Stan Wong, and the picks he has are almost a year ago, so March of 2024, but the end of the month. Your first past pick we'll talk about is Dollarama. At the time, it was 103.05. I'm just taking a look at it now. It was 148.29, now at about 147.66. So still a return of 44%, and then same for total return, 44%. Have they expanded? What's going on with Dollarama?
Yeah, first of all, we still own it. We still like it. We're still adding it to it on opportunities. They're making some expansion, but I think key about this is that they have very little competition. Unlike its U.S. counterparts, whereby there's a little bit too much competition, Dollarama has very little competition. Now, you're paying up a little bit at 35 times forward earnings, but you're getting 15% earnings growth going forward. They grew 18% over the last 5 years. And again, very little competition in Canada. And I think that with the cumulative effects of inflation over the years, and the fact that we've got a bit of an uncertain scenario in Canada in terms of the economy and so forth, I think consumers are getting more cost conscious, and Dollarama is a beneficiary of that. And really, like we all talk about dollar stores as really recession resilient business models, and they continue to expand their stores. If you look at the stock, it's actually been outperforming the TSX, outpacing it since its IPO in 2009.
Got it. Okay, so Dollarama, one to look into for the future. Let's go to your past pick from March of last year, which is Novo Nordisk, which is recommended at $129 American, and now down to 76, and a drop of 41% in the returns, total return the same. This was a company people talked a lot about because their obesity drugs were doing really well, and what has happened to Novo Nordisk?
Yeah, so we're out of the name for a little while now. I think it's actually, sentiment is pretty rough on the name, but it's fairly cheap now at 22 times forward earnings, 18% earnings growth. They grew their earnings 19% over the last 5 years. With that being said, there's regulatory scrutiny. They've lost a little bit of market share to Eli Lilly, which we hold still at this point. And the stock's now dropped below the 200-day moving average, and the 200-day moving average is moving down. So, not something that we'll consider going back into now, but I can certainly see us revisiting this name because I think the growth of GLP-1 drugs is there. The fact that GLP-1 drugs are now being expanded for additional uses such as heart disease and kidney disease and even addiction for that matter, I see a path for Novo Nordisk and Eli Lilly to sort of re-ratchet up and the shares going higher. We're not going to buy Novo Nordisk back right now. We own Eli Lilly, but I think this is a name to keep an eye on. We're out of it for technical reasons. But again, something that we'd reconsider in the future.
Why did you decide to hold on to Eli Lilly as opposed to Novo Nordisk?
So Lilly was grabbing a bit of market share away from Novo Nordisk. Eli Lilly is a bit more diversified. They're not just in the diabetes and weight loss management drug space, whereas Novo Nordisk is pretty centered on those two areas.
Got it. Okay, let's go back to your third top pick from last year, Palo Alto Networks. At the time, it was $286.69 American. Now 176.50. Is that correct? 176.50. Okay, so we have a drop here, I guess, of 23%. That might be incorrect with the arrow. Palo Alto started dropping, I guess, in January, then went up a little and come down, and now it's at 176.70 is what we're saying. What's going on with them?
So the stock is up. I think it's not taking into account the split that might have happened.
Okay.
So the stock is up actually quite nicely over the past year. We are out of it now. We did take profits to switch into CrowdStrike, going back several months, which now we're out of CrowdStrike, so profits on that. So in the cybersecurity space, I think that those names, Palo Alto, CrowdStrike, Fortinet, great names to own long-term because cybersecurity threats are only going to get worse and bigger. That problem is not going to go away. So that secular demand for cybersecurity, software, and services will continue. We would be paying quite a bit. Like Palo Alto's at 53 times forward earnings with about a 15% earnings growth rate. So we want to see a little bit of a tampered down type of PE. It did grow their earnings by over 40% over the last few years, so 5 years. So going forward, the next few years are going to be a little less than the last few years. As you know, with business expenditures and capital expenditures, they kind of go in and they stop spending, and then they all of a sudden spend a lot. So right now, a little bit of a slowdown in capital expenditures from businesses and in the areas such as cybersecurity. But I think long term, whether it's governments or companies, winners and all that go through these cybersecurity situations.
Upgrades, essentially.
Yeah, they're like, it's going to cost them more than having these problems than to pay for Palo Alto Network or Fortinet services or CrowdStrike.
Great. All right. We do have to leave past picks at this point. We're going back to your phone calls when we come back. Stan Wong with us, portfolio manager, Scotia Wealth Management. Your questions today on North American large caps and ETFs. Welcome back to Market Call. We are going straight to your phone calls. Cousin's on the line in Toronto. Cousin, what's your question today?
Hi, can I have a guest view on Shopify, please? Thank you.
Thank you. Go ahead. Shopify.
Thanks for the call. So, Shopify's down like everything else a little bit. It's down about 30% from recent highs, still above the 200-day moving average. So technically, the shares still look sound in the fact that the 200-day moving average itself is moving a bit higher. We don't own the name. In the tech space, I tend to look to the U.S. because I think there's just much more variety and much more depth in the U.S.
Okay.
With these shares, I think it's a bit pricey for me at 61 times forward earnings. Yes, we'll see a 20 to 25% earnings growth rate going forward, but that would put it at 2.5 times PEG ratio. I think there's other names in the U.S. that I would prefer in the tech or tech-oriented space, like such as an Amazon and so forth.
Okay, so Shopify down today by about 472 is what we're looking at now. Okay, let's go back to your phone call. Sal's on the line calling from Toronto. Hi, Sal.
Hi there. Yeah, my question is on Goldman Sachs. I was wondering if you think now is a good time to make a position in that, or if you think there's further downside ahead. Thanks so much.
Thanks for that question. So we do own Goldman Sachs in our portfolio. I like the name. I think that, as I mentioned, financials should be one of the leaders going forward, as it had been going into this volatility. The shares are down about 22% from just last month's highs on concerns of, hey, is there going to be a recession because of these tariffs and so forth, which again, I think it's just premature to sort of think along those lines. At the 200-day moving average, it seems to be a bit of a support level, so that could be an area in which we can add on shares or take a new position in this name if you don't already own it. Obviously, one of the leaders in the investment banking space and wealth management space. More deregulation in the U.S. will benefit names like Goldman Sachs, and more deregulation can spur more M&A activity, which is beneficial to investment banking fees for a name like Goldman Sachs.
We've been talking a lot about tariffs, as you know, and I'm wondering, since Donald Trump has promised deregulation, have there been yet any murmurs of what that's going to look like, and have they sort of been in a sub-headline because everybody's been talking about trade war?
I would say it's been a bit of a sub-headline because we don't know exactly what that will look like. We just know that it's likely going to come because that's part of the playbook with this administration: deregulation, lower taxation, and tariffs, unfortunately.
So we just don't know when.
I think it'll be, again, looking at the fact that we have midterm elections next November, I think it'll be sooner than expected.
So timed appropriately that people benefit at that point.
I would. Again, who knows if names like Goldman Sachs is going to have another 5% downside. But I would suggest that when you look at the bearish sentiment with the AAII, the American Association of Individual Investors, like that's high bearish numbers now. Similar to what we saw in 2008, 2009. So we know how the markets reacted when the bearishness hit those levels. You look at the fear and greed index, extreme fear. Last time we saw that was August of 2022, March of 2020. So when there's fear in the streets, I think there's an opportunity. And as Warren Buffett has said, be greedy when others are fearful.
Fear and greed index. All right. Let's go back to the phone lines. Ghulam's on the phone line from Toronto. Hi, Ghulam.
Hi there. Good afternoon to you both. My question, I have a small holding on SOXX and ZQQ. and I think they've taken a little bit of a beating in this year. I'm wondering if I should hold on to it for further upside or just diversify. I know Stan likes financials, and the ones I was looking at is Bank of Nova Scotia and CIBC. So ZQQ and SOXX, what do you think I should do? Wait or just take my profits a little bit? Thank you for your assistance. Bye.
Sure. Thank you. ZQQ.
Yeah, so with ZQQ, it's just a NASDAQ hedge back to the, or NASDAQ 100 hedge back to the Canadian dollars for, currency safety. Obviously, you're going to have Apple, Microsoft, Nvidia, Amazon, those types of names. For me, I think that I'd rather pick and choose some of the names in the tech space because some are very expensive and some are very reasonable. So that's the way I would approach it. However, based on the investor, you might want to just sort of take a broader approach. This one, you're paying 39 basis points. I think that you could probably find other strategies, particularly in the U.S., whereby you can buy the NASDAQ or NASDAQ 100 for a little bit less in terms of management fees. The shares are down around, the units are down about 14% from the highs, which sounds like a lot, which it is. However, in the past 1 year, if we sort of look back, we're still up 6.6% in this space. In the past 5 years, it's returned almost 21% a year. So a little bit of volatility is the toll we pay for investing in these types of things.
Basically, you have to have a stronger stomach if you're going with the straight stock as opposed to the ETF.
Yeah, have the Pepto-Bismol ready.
At hand every night. Thank you very much. Okay, let's go back to the phone lines. Gay Pano is on the line from Montreal. How are you?
I'm doing fine.
What's your question?
My question is on Manulife, on the short term and long term.
Okay, thanks for the question. Stan?
So we do own Manulife in the portfolio. It's a name that I really like. I think valuation, it looks attractive. We actually also added Sun Life more recently. The shares have actually held up quite nicely. Manulife's down about 11% from the highs earlier. It's actually back to November that it was at the highs. So not too bad considering that you're getting a pretty nice dividend as well. And it's holding above the 200-day moving average, as well as the fact that the 200-day moving average is moving upwards as well. So we do like this name. The insurance space gives you that sort of mix of decent growth, but also there's some protectiveness with the dividend yield, in this case, 4.3%.
Okay, 41.24 is where we have Manulife at this hour. Okay, let's go back to the phones. We'll get another caller in. Frank is calling from Huntsville today. Hi, Frank.
Well, hi. Today is my birthday, and I came into some extra cash.
Happy birthday.
Thank you. I was thinking of buying BCE, but I'm concerned about two things. One, is it a good time to buy BCE? And secondly, is the dividend safe that the yield will be maintained at 11% if I buy today? I'll hang up and thank you very much.
And just a reminder, of course, BCE is the parent company of CTV and BNN Bloomberg here. So full disclosure there. BCE has taken a hit, like some of the telecoms lately. It is at quite a low level at 35.10. What do you expect from BCE? I know a lot of people are expecting the dividend to get cut.
It seems likely that the dividend will be ratcheted back a bit just to get the cash flow back up and so forth. When you look at most of the telecom stocks out there, including the ones in the U.S., it's just been a challenging time. When interest rates started to move down a little bit, going back, like 6 months or a year, some of the dividend stocks started to move higher. You can see that with BCE. It moved up a little bit, stopped falling, but it started to move down a little bit again. I think that we go back to earnings and so forth, and we think that with earnings, it'll be challenging for BCE just because of the transition and the types of businesses and the sale of their share in MLSE. So in the next few years, earnings looks like it's going to be really flat or maybe even slightly negative. So as an earnings growth type of guy, I'm looking for companies with earnings growth. So BCE is not in our portfolio. Yes, the dividend is attractive, but I'm seeing on Bloomberg that the expectation is that the dividend will be cut over the next while.
Got it. Okay, we are going to take a quick break. Stan Wong in-house taking your questions. We're back in a moment. Welcome back to Market Call. Let's get back to the phone lines. Robert has been holding on the line, and he is in Toronto. Hi, Robert.
Hi, thank you for taking my call. I'd like to know more about Nvidia. Would you get back into it, and also do you own it? Thanks.
Okay. Were you an early buyer of Nvidia by any chance?
We took profits, and now we're back into it more on the recent purchase because it dipped down. So we do own the shares right now. As you know, the shares are cheaper than it has been in a very long time at 25 times forward earnings with a 31% growth rate. So the PEG ratio is below 1.0, which is pretty rare in the technology or communication space. The only thing, has sentiment kind of changed around the tech names. The shares are down 26% from previous highs, so quite a drop. And the shares are also trading a little bit below the 200-day moving average, although the 200-day moving average is still trending higher. So if the market recovers a little bit, I think this will be a name that will lead, just given the fact that its growth prospects and the fact that it had been a leader, prior to this little bit of volatility in the last little while. We look at the fundamentals, and it's a cheap name relative to its growth rate going forward. And it hasn't been this cheap in a long time.
Okay.
So
if
we
you want to dip in,
I would take an exposure to this name for a growth investor.
Got it. Okay, let's move on to Dana. Dana's calling from Regina. Hi, Dana.
Hello. Thank you for taking my call. My question today is on the ETF SCHD, the Charles Schwab ETF. I'm looking at it as a play outside of the tech or S&P 500. It seems to have a lower volatility. Its historic gains since inception has been pretty good at 12+%. Its compounding dividend rate is over 12% since inception, and I'm just wondering what your thoughts are on an ETF like this to weather a slowdown in the economy and or recession moving forward, and if you can see that it could keep that momentum going forward. Thank you.
Yeah, so thanks for the question on this ETF. So this is basically based on the Dow Jones Dividend Index, or the Dow Jones 100 Dividend Index. And you're going to have names like AbbVie in there as a top name, Coca-Cola, Amgen, Bristol Myers, and so forth. So generally, higher dividend names. I personally prefer an ETF like VIG, the Vanguard Dividend Appreciation, because I think that it's important to have companies that are increasing their dividends, although you may get a lower dividend now. It's important to get that appreciation dividends in case interest rates start moving higher, which will make static dividend payers less attractive and could move down. Nothing against this Schwab strategy. I think that the composition looks good. It's performed well over the last while. You're getting a 3.9% dividend yield or so forth. You're paying 6 basis points for the ETF. In terms of a management expense ratio. So I think it's a pretty fair name. Just in our portfolios, we like VIG just slightly more.
In comparison. Okay. Back to the phone lines. Kevin is on the line from Grimsby, Ontario. Hi, Kevin.
Hi there. My question's on AMD. I'm just wondering if this is a good time to invest in this, or does the analyst see a future in this company at all?
Okay, so AMD.
Thanks.
Advanced Micro Devices?
Yeah, thanks for that question. So AMD technically looks pretty challenged at this point. The shares are down about 57% from its highs back in last March. Okay. And the price is now below the 200-day moving average, which itself is trending lower. So from a technical structure, not looking very great for AMD. I'd revert back to buying Nvidia shares, just given its momentum and its earnings momentum. Yes, AMD is, second in command in terms of its, standing in the semiconductor space, but I think that Nvidia is just that much further, and the sentiment is stronger on Nvidia shares.
Got it. Okay, let's see if we can get one more caller in before we have to take a break. Philip is on the line calling from Toronto. Hi, Philip. What's your question?
Hi there. I was just wondering if you thought Amazon or Apple were trading at a discount right now.
Okay, so let's check on both. We'll check on Apple first and see where we are. Almost everything's been trading at a discount over the past few weeks, so let's have a look. Apple down to 212, down 2.2%. over the year, but $4 today.
So Apple's down about 19% from recent highs. You're paying about 2 times PEG ratio for the name. So, actually, I should say up front, we own both names. We own Apple and we own Amazon for different reasons. With Amazon, you're paying, around 30 times for about, 14, 15% growth rate. So from a PEG ratio perspective, they're about the same. Obviously one's a bit more consumer oriented than the other. You're buying Amazon for the cloud, which is growing very, very quickly over time. So very different types of businesses. Apple's a bit discounted just given the fact that over concerns about, how much momentum do they have in China, which I think is overplayed a little bit as well. If I were to choose one name over the other right now, I think Amazon's probably a little bit cheaper in terms of how it's sold off. And it's also the 200-day moving average. So if we were to choose one name to, add to, it'd probably be Amazon today.
Okay, we do have to take a quick break. We're going to be back with the forward picks from Stan. We're back in a moment. All right, time now for a look at top picks from Stan Wong, who joins us in-house. His first forward-looking pick is Expedia Group. Expedia Group, of course, on the NASDAQ. And why Expedia? We were talking a little bit during the break about the fact that people are worried about a recession. You don't necessarily have the same concern. So you think people still have money to spend and go on vacation? Is that the way you're looking at it?
Yeah, first off, I want to say this is a very recent add to our portfolio. Expedia is down around 24% from recent highs, which made it, somewhat attractive in terms of an entry point for us. I think global travel demand remains resilient. You can see that through the U.S. TSA checkpoint numbers, higher than it was pre-pandemic and holding very steady. We're seeing, strong performance in lodging, vacation packages, flights, and so forth. The consumer remains pretty resilient. If you look at retail sales in the U.S. over the last 10 years, it continues to move higher. Expedia's got a lot of brands. It allows them to serve very diverse customer bases or segments. So obviously Expedia.com, Hotels.com, Vrbo is under Expedia, and Trivago is mostly owned by Expedia as well. So they've got very different, arms to collect revenue. They've improved their digital platform. They've saved a lot of money during the pandemic as well. So, a lot of cost efficiencies from management, cash flow is strong. And we still see this post-pandemic recovery whereby people are making up for lost time during the pandemic and traveling. And what's also interesting is that, more companies provide remote work flexibility, which allows you to work from Florida, Bahamas, and so forth. So that's actually helpful to Expedia. And honestly, when you look at the growth rate, we're looking at about 19% earnings growth rate, which is kind of key to what we look at. We look at the macro is important, but how is the company looking to do? We're looking at a 19% annual growth rate going forward. It performed 19% over the last 5 years, and we're only paying 11 times forward earnings, which I think is a pretty good PEG ratio and attractive name to go into.
Got it. Expedia being the first pick. Your second pick is MasterCard, which is getting, I guess, into fintech as well.
Yeah, so MasterCard is, not as interesting as Expedia, but it's a name that we've held for a while. They're, collecting probably $32 billion in revenues this year on a forecasted basis. They're obviously capitalizing on the shift to digital payments, going from cash to digital payments. In relation to travel, increasing cross-border volumes is helping names like MasterCard and Visa and so forth, simply because cross-border transactions are high-margin transactions for these companies. And as you mentioned, getting into fintech and AI and open banking is helping unlock, certain areas of revenue for names like MasterCard. A lot of interesting strategic partnerships that they're doing and acquisitions. If you look at our arena in Scotiabank, they've got lots of partnerships in Scotiabank Arena, lots of partnerships going on there. Cash flow remains high. It's a toll booth type of business. They're going to make money whether or not you use a debit card or a credit card on both flows. Yeah, exactly. And performance has been strong. I mean, they've been exceeding expectations on quarterly results. We're seeing about a 13% annual earnings growth rate going forward, 15% going back the last 5 years. Shares are down about 10 or 11%. Not as, down as some of the other names that we're looking at, but still down about 11%. So again, an attractive entry point.
A good time to get in. Okay, let's go to your final pick of the day, which is Netflix. Netflix has done pretty well. Do they have room to grow, is my question.
I think what's happening is that they're clearly winning the streaming wars. Whether or not that's Disney or whatnot, they're beating Disney Plus, they're beating all those names, told by its global subscribers. It's over 300 million today. So that's driving pricing power. Their somewhat new ad-supported tier and crackdown on password sharing. Even I get some of the notifications that, hey, is this really your account for my own account? That's improving margins. It's increasing subscribers and so forth. And their investment in original content and in expanding internationally is helping. You look at some of the things they're doing more recently, live sports, NFL, WWE, pro wrestling, and so forth. Those events are garnering a lot of new interest.
Into that live market now.
Exactly. I mean, you look 5-10 years ago, you think about where else are you going to watch a live sports game, other than cable TV? That's changed. Now you can watch on Amazon Prime, you can watch on Netflix and so forth.
Okay.
So, told by that big deal that they did with the WWE, that's a big deal. So cash flow's increasing. We see 23% earnings growth rate going forward. Shares are down to about 15%.
Great. Stan Wong, we've got to leave it there. We're out of time, but thank you for coming in.
Great to be here.
And that's it for us on Market Call today. Thanks very much for tuning in. We'll see you again tomorrow.